Okay, so in this video we are going to explain the difference between internal rate of return and the net present value. So we are also going to look at the example on how you should calculate the difference between these two, and also we are going to explain how these tools should be used, as well as the comment that you need to lay down after you do your calculation. Okay, so let's look at the notes that I drafted. So when we talk about IRR, which is internal rate of return, it is discount rate that make a net present value of an investment zero. In other words, it is the rate which the present value of the project cash flow equal to present value of its outflow. Okay, so another explanation of net present value is a method used to evaluate the profitability of the investment by comparing the present value of all expected future cash flow with initial investment. Okay, net present value help to determine whether the investment is valuable or not by taking into account the time value of money. Okay, in a simple term, the answer that you should get under IRR, it must be in terms of percentage, and the net present value, it must be in terms of rand. Okay, so let's start with the internal rate of return. So when we talk about internal rate of return, you need a financial calculator to do this calculation, or you can also use a software that is approved to calculate internal rate of return. But when we talk about net present value, you can also use the formula to do this calculation. Okay, let's take the formula that we can use to calculate our net present value. Okay, I'm gonna show it on the screen as well. So you can say a net present value is equal to, number one, you can say a cash flow at a time of 0. Okay, let's start here. At a time of 1. Okay, then after that you need to divide it by 1. Okay, beside this you can just say it, okay, we can use this one, it's fine. You can divide it by 1, open a bracket. Remember this one, guys, is always there, it's on the formula, then you say it plus R. When we talk about R, we are talking about a discount rate that you are going to be given. So if they give you 20%, for example, you need to write it under as a decimal like this. It's 20%. 30%, 0.3. Just like that. Don't write it like this. You are going to get the wrong answer if you write 20 instead of 0.2. Okay, then after that, you need to write as many as possible. If they give you cash flow of 10 years, you have to write this 10 times. You just change here. When you go to second year, you write 2. Third year, you write 3, and so on and so on. You're just going to add everything. Okay, now this is the formula that you can use to calculate net present value. Okay, then when it comes to this side, internal rate of return, you need to use a software so that you can get it. By normal calculator, you won't get the answer. Okay, now let's go to example. Maybe before we go to example, why do we calculate internal rate of return and net present value? We want to check whether it's worthy to take a project or not. Okay, how are we going to see that? When we calculate a net present value, our net present value must be positive. It must be positive for you to say, yes, we are going to take this project. Okay, then when we come to internal rate of return, it must be more than a percentage that they give you, the rate. If they give you the 10%, when you calculate internal rate of return, it must be more than that. then after that you can now conclude that it's worthy to take a project. Okay, but if it is below, you can conclude that it's not worthy to take a project. So this is how we use this tool to determine whether it's worthy to take a project or not. Okay, let's go to example. So the example that they give us, they said a company is considering investing 10,000 in a new project. The project is expected to generate following cash flow over the next 5 years. Year 1, we have 3,000. Year 2, 4,000. Year 3, 2,000. Year 4, 3,000. Year 5, 3,500. And the company rate is 10%. So now how are we going to calculate that? Very simple. We are going to use this formula to calculate our net present value. Okay. Now a cash flow at a time of year 1, they give us amount of 3,000, which means that we are going to say our net present value is what? So we are going to say 3,000. Okay. We are going to say 3,000 and we divide by, remember, cash flow at a time of 1. This one is not formula. It simply means that it's year 1. It's 3,000. Then now we divide by 1. We open a bracket and say 1 plus. And the rate, they say 10%. Remember I said you have to write it as 0.1, not at 10%. Okay, which means that we close for year 1 now. Then after that, we add the second year. We're going to use the same process. We're just going to say year 2, it was 4,000, which means that you were going to do it like this. 4,000. And said 1, open a bracket, 1 plus 0.1. Okay. Because it's year 2 now, we needed to do what? To say 2 this side. Then when we go to year 3, let me show you it here. Year 3, they said our cash flow at the time is 2,000. 2,000, and we said open a bracket 1, and we say divide by 1 plus a percentage is how much percent? Is 0.1, 10%. And now you close brackets by 3. So when you go to year 4, you're going to do it like that. So if you do all this calculation, you are now going to get amount of 12,000. You must add until year 5. Then you will get amount of 12,899. I'm going to show the calculation on the screen as well. And 44, 12,899 and 44. Okay, you can use dollar or rand, it's fine. Okay, so this is our net present value. It's positive, it's fine. Now because we can't calculate IRR because we don't have a software here and we don't have financial calculator, let's just assume that our IRR is how many percent? It's 15.2%. Unless they said you have to bring financial calculator or software in class, they are not going to require you to calculate IRR. They are going to give you and you calculate this one, then you put a comment. Okay, let's say it's 15.2%, which means that now when you compare 15.2% and you check, remember they said that the company require 10% of return. Simple means that this 15.2 is more than 10%. Very simple, which means that you can say yes, we are going to do what? To invest into this company because our internal rate of return is higher and our net present value is positive. Simple like that. Okay, but if this one was negative and this one maybe was 5%, we were going to reject this project because it was not going to profit a company. That's how you should do it. So we are going to do part 2 as well, which we are going to try to calculate IRR, but using a financial calculator, because remember, I don't think you can be allowed to go to exam holding a software. You have to put it on your cell phone or a computer. Okay, so now, yes, we have concluded that we are going to do what? To take this project, which means that we conclude that a project is accepted. So I hope you have learned something. Don't forget to subscribe, guys, and like this video and share with friends who want to learn this different between these two, as well as other videos that are going to come for management accounting and financial accounting. Stay tuned so that you can also learn other topics.